On Point with Craig's Investment Partners.
The information provided here is general in nature. It's not financial advice. It doesn't take into account your financial situation, objectives, goals, or risk tolerance. All investments are subject to risks and none are guaranteed. So before you make any investment decisions, we recommend you contact an investment advisor. For more information about our services in that regard, you can go to our website, which is craigsip.com. Welcome to On Point. I'm Mark Lister, Investment Director at Craig's Investment Partners, and I'll be talking about a range of topics, including economics, portfolio strategy, investor education, and anything else that's happening out there in financial markets. Morning, all. I wanted to talk again about rising bond yields, and I do appreciate we've discussed this a couple of times over the last fortnight or so, but it's still one of the biggest stories and themes across financial markets at the moment. And I'm getting a lot of questions about why we're seeing bond yields rise, what it means, whether investors in fixed income assets should be doing anything, changing anything, moving in, moving out, and how investors should be thinking about this backdrop. So I did want to just delve a little bit deeper than we have during the last couple of episodes where we've touched on this topic, but not in any great detail. I guess for a start, what are bond yields? Bond yields are the market return in terms of the income you'll get from bonds that trade freely on global markets. So you've got government bonds, you've got corporate bonds. People buy and sell those on markets every day, just like the share market sees shares trading every day. So the prices of bonds can move around, and therefore the yield on bonds can move around depending on where they're being priced at any given time. And at the moment, you've seen bond yields rising, which in a way means that people have been selling those bonds and prices have been falling, which means the yields have been going up. So that has reverberated around the world in terms of borrowing costs. Higher bond yields means higher borrowing costs. We've seen mortgage rates rise in New Zealand, even though the official cash rate hasn't changed since May. And part of the reason for that is those rising global bond yields. Remember that central banks, we talk about central bank interest rates, the official cash rate here in New Zealand, the Fed funds rate in the US, the RBA cash rate across the Tasman. Those are very short-term interest rates. They're sort of the overnight rate. And that's important for borrowing costs for mortgages and so forth, term deposits and everything else. But the further out you go in terms of the length and the term of lending or borrowing, when you get to sort of 2 years, 3 years, 5 years, 7 years, global bond markets have just as much impact as what central banks are doing. So it's not all about what the OCR is doing. It's also about what is happening in those global bond markets. And the rise that we've seen over the last few months has not only seen bond prices fall, but it's also taken the wind out of the sails of other asset classes, including the share market, because I guess when you boil it down, everything sort of starts with the risk-free rate, and nothing's truly risk-free. But the closest thing to risk-free are securities that have a counterparty that's very reliable, such as the New Zealand government, the US government, the Australian government. Bonds issued by those entities are as close to risk-free as you're going to get. That's as reliable as you'll find in terms of the likelihood that you'll be repaid and that you'll be also paid that sort of interest or coupon along the way. So government bonds from those developed countries, those reliable, credible nations, are pretty much the representation of the risk-free rate. And if the risk-free rate is going higher, then all of those other risky investments out there, whether it's shares or houses or businesses or crypto or anything else out there, people are going to expect a higher return, aren't they, to compensate them for that higher risk, because what they can get without taking on any risk is giving them a better return than it was yesterday or last week or last month. So the risk-free rate is a really important building block of valuations elsewhere. And when you see risk-free rates rising, that puts downward pressure on the price of all those other assets like the share market. And that's what you're seeing at the moment. People are asking for a higher return to put their money at risk in the share market because the opportunity cost of doing that is going up because they can get more in terms of a risk-free return than they could before. So that's why it's important for everything. And we've seen those bond yields rise quite a bit over the last couple of months. At the end of last week, the US 10-year Treasury bond, which is somewhat of a benchmark in the government bond or the global bond markets, the 10-year yield rose to, or closed at 4.8% at the end of last week. And that's the highest that we've seen since 2007. And it's up quite a bit from where it was at the end of July. End of July, it was just below 4%. So the moves have been quite significant. They haven't just been limited to the US. We saw the yield on a 30-year government bond in the UK close above 5% for the first time since 2002. They went close to those levels last September, but pretty much at the highest we've seen in 21 years. And it's a similar story here in New Zealand. Our 10-year government bond yield last week pushed through 5.5% for the first time in more than 12 years. So we've seen a big upward move. Why has that happened? Well, there's a few reasons, but interestingly, inflation actually isn't one of those reasons. Recent inflation readings have come in below forecasts, not by a lot, but slightly below forecasts. And expectations for future inflation have been falling rather than rising. So we can't blame inflation coming in hotter than expected for the rise in bond yields. That hasn't been it. Things that have probably had an impact, there's probably a range of them. Central banks have been pushing that higher for longer message, even though the Reserve Bank of New Zealand, the Federal Reserve in the US, the RBA across the Tasman, none of them have increased interest rates at the last couple of meetings. They have made a point of reminding everyone that interest rates won't be going down anytime soon, that we might be near the top, but from here they will plateau and they will stay at that level for a period. So it's been about that higher for longer message that markets have really taken on board. You've also got the prospect of more issuance. Governments around the world have got more debt than they've had in the past, particularly after the pandemic. Took on a lot of debt to keep people safe, to shore up the economy, keep people employed and so forth. All of that costs money. A lot of it was debt funded. Now they're sitting on higher debt levels than they've had historically. And that means that they will have to sort of keep that debt going over the short term at least. So more issuance means that those governments might have to offer more attractive rates to make sure that they get the money in the door that they need. So that's sort of supply and demand at work. And I think probably the strongest factor outside of those things, and there's probably a couple of others as well, but the biggest factor is probably stronger than expected economic activity. Many economies around the world, like the US, like New Zealand, have been much more resilient than expected, and that's fueled the debate about where the neutral interest rate is. And the neutral interest rate is somewhat conceptual. That is the level of interest rates where an economy is in balance. We're not speeding it up by having interest rates too low. We're not trying to slow it down by having them too high. It's sort of that steady state level. And it's really difficult to pinpoint exactly where that tipping point is, but it's an important guide for policymakers. And that neutral interest rate is probably higher than we've thought it was over the last couple of years. You look at America, where the Federal Reserve has a policy rate of 5.5%. That's the highest since 2001, well above where they were at 18 months ago. They were pretty much at zero 18 months ago. Similar story in New Zealand. Now, our interest rates aren't, you don't have to go back as far as 2001, because we're still not nearly as high as we were before the GFC. Our OCR leading into the GFC was about 8.25. Today we're at 5.5. So we're the highest since 2008, which is still a long time ago. And the pace with which mortgage rates have increased has been significant. If you look at the moves of the last 2 years, we've never seen an increase as aggressive as we've seen in the last 2 years since 1986. So if you had told a few economists a year ago, 2 years ago, that we would have seen that sharp move in New Zealand, that you'd have the Fed funds rate at the highest level since 2001. A few of them probably would have predicted that, well, geez, one or both of those economies would be in recession or in a pretty difficult spot against that backdrop. But that hasn't been the case. We've come through that and we've seen a bit of a slowdown, but we haven't fallen into a heap nearly as much as some might have expected. And so that economic resilience has been really surprising to a lot of people. And I think with the benefit of hindsight, we can say that the level where interest rates start curbing or hindering economic activity is higher than many would have thought. In the US, at that 5.5%, yep, we're putting the brakes on at those levels, but neutral is probably, might be around that 4% level, which the Fed only got to at the beginning of the year, late last year. So they haven't been slowing things down for as long as we might have thought. Same story in New Zealand. I think in a long-term sense, our Reserve Bank estimates the neutral rate to be around 2%. But I think in a short-term sense, because we're in a more buoyant period economically than we have been for a little while since we've come out of COVID, the short-term neutral interest rate in the eyes of the Reserve Bank is probably in that 3.5% to 4% zone. So again, we haven't been actually putting the brakes on in terms of our OCR settings for quite as long as we might have thought. So that's all good news. We should be encouraged by that some of these economies, including our own, including the US, have been stronger. They've been more resilient. They've been able to weather the storm of higher interest rates and still keep ticking over. That's a good thing. It's good for economic activity. It's good for growth, good for spending, good for businesses, good for corporate earnings. But it comes with a cost because that goes hand in hand with monetary policy being higher, interest rates being higher and staying higher for a longer period. We can't have our cake and eat it too. If you're going to have that economic resilience, then you're probably going to have to live with those higher interest rates for a period. So when it comes to investors, and I guess I'm talking to fixed income investors here, not so much share investors, because that's another episode altogether to talk about those linkages between inflation, interest rates, bond yields, and share prices. That's probably another session, which maybe we'll look at sometime. But in terms of fixed income investors who are reading lots of headlines about the bond sell-off and bond prices falling rapidly and bond yields rising, and that being terrible for those conservative investments and fixed income investments, I don't think there's any need to panic. And one key reason is that here in New Zealand, our bonds and the types of securities that most private investors invest in are of a much shorter tenure, a much shorter time frame or maturity than what you see overseas. And that's important because the longer a bond has in terms of its maturity, the more sensitive it will be to changes in interest rates, because those cash flows and those returns are further out in the future. So when you try and bring them back to their present day value, there's a greater change, because you're discounting them back over time, depending on what the prevailing interest rates or costs of capital are. So when you've got these very lengthy bonds overseas, 10 years, 20 years, or even 30 years, those bonds are going to be very sensitive in terms of the price and what they're worth, what people are willing to pay for them. Those prices will be very sensitive to changes in interest rates. So when interest rates are going up, you'll see those very long-term bond prices fall more heavily than the sort of shorter duration bonds. And the opposite will happen if we find ourselves in a position where interest rates are going down. If there's an economic slowdown, if there's a recession, if inflation falls, if there's not a lot of nervousness that enters markets, then some of those very long-term bonds will start looking quite attractive because under a falling interest rate environment, they will have more potential upside. But at the moment, it's those long-term ones which are suffering. And we don't have a lot of those in our market in terms of the corporate bonds that private investors typically buy. The ones that we sort of, the pond that we fish in is full of bonds that are more of a 2, 3, 5, 7 year tenure, and those don't have that same sensitivity. They will decline as interest rates rise, and we've seen that a little bit, but the falls have been much more modest. And our NZX investment grade corporate bond index, which is a good proxy for what many private investors would have in their fixed income portfolios, that index, it has fallen in the last couple of months, but year to date, it's still in positive territory. It's actually outpaced the New Zealand share market, the New Zealand housing market, and it's performed a whole lot better than we've seen from some of those international markets. So, look, I don't think we need to necessarily panic about our fixed income investments. Where bond yields go from here is always a difficult one to predict. They could push a little bit higher over the near term, if people still have confidence about that economic growth story and believe that central banks will keep rates higher for longer, or if people believe that there might still be another rate hike or two in the pipeline. And some people think there could be in the US or even potentially in New Zealand. However, what we do know is that bond yields tend to peak or reach a top around the same time that central banks pause and have done enough. And we're probably quite close to those points. In New Zealand, our Reserve Bank last increased the OCR in May. It's been on hold since then. Maybe they'll do more, maybe they won't. And in the US, we've seen the Federal Reserve pause at its last meeting or two. Maybe they'll do a little bit more. Maybe they've done enough. I think there's a good chance that we might already be at the top. And if we're not already there, then I think we're very close to the top. So my suspicion is that the peak in bond yields is somewhere around here. Always impossible to pinpoint. But what I think it's easier to form a view on is that in a year's time, in 18 months' time, there's a very good chance that interest rates will be lower than they are now. And with that in mind, sort of trying to look out a little bit longer than just the next 1, 2, 3 months, I think for borrowers, you just want to be a little bit mindful about locking yourselves into those higher rates for too long. Get some good advice from a mortgage broker or someone who knows what they're doing. You don't want to lock in these high rates and be stuck with them if things might sort of taper off over the next few years. And as far as investors go in fixed income, probably the opposite. You want to take advantage of these reasonable yields. We've got the highest yields out there that we've seen in 10 or 15 years. They might last for a little bit longer, but they might not last forever, and things could change. You never know what's around the corner. So it could be quite a different backdrop in 6 months, certainly 12 months. So my advice to those people is that they should start thinking about how they maybe take advantage of this environment. It's not all bad. There is a silver lining, and that is that conservative investors are being offered the best returns that we've seen in a very long time. Hopefully that's useful. If you want to know more, I'm sure one of our advisors would love to have a chat and talk about opportunities and other market issues. But for the time being, hopefully that is useful and sheds a little bit of light about what we're seeing in global bond markets and what might be ahead of us.